All right, so next is actively build your savings and investment. That's A. So we've taken K, that's the knowledge first. We've taken I, that's increase your active income. Then actively build your savings and investment. After having the knowledge of this and working towards increasing your active income, then the next is to actively begin to build your savings and investment portfolio. So if you're young and you're just picking up a job, or anybody just picking up a job or in a job already, because the best time to plant a tree was 10 years ago, the next time best time is now. So begin to actively build your savings and investment. Okay, and there are two types of investments. You have the growth investment and the defensive investment. We pick these two for the basic class. Okay, so the growth investment is the investment that focuses on increasing your capital. Yeah, you don't have as much money, you don't have as much cash, and then you want to begin to increase your capital. Okay, this strategy is used to invest in fast growing assets or companies, and you have different options you can invest in. You can do stocks of fast growing companies, especially tech companies. These are often categorized as growth investment. Then you also have real estate and cryptocurrency. Okay, because looking back at stocks, if you had invested earlier on, you would have made a lot of money. Imagine that for Tesla started, the IPO was at $17, and over time it went as high as $1,200 last year, and presently, and it has gone through lots of stock splits. Of course, that means you would have made a lot of money, and it's currently about $760 as we speak. So it's about looking at the growth aspect. I'm still going to take the stocks, real estate, and cryptocurrency in another different class. Okay, so you have defensive investment. The investment seeks to reduce downside risk. So if you have a low risk appetite and you want to go for more of defensive investment, the challenge with this is that you would need to forego high returns. Okay, so you have say 10%, 6% per annum. That's the kind of returns, and this is oftentimes recommended for those who wants to play safe but still wants to invest. They are not after growth investment, and some people rather put their money in defensive investment like treasury bills, and then take the money from the treasury bills and put it into growth investment. Take the interest from the treasury bill and put it into growth investment. Okay, so under this you have high interest savings, you have bonds, you have treasury bills, and you have ETFs. So even there are some stocks, especially stocks of established companies that often pay dividend, could also sometimes fall into the defensive investment because the yield becomes predictable over time. So I encourage that everyone have these two kinds of investment in their portfolio so that one edges against the other. And when I advise people based on your age and your risk capacity, you might want to decide what percentage goes into growth investment and what percentage goes into defensive investment.